Welcome to our video on reserve requirements and their role in the financial system. In this video, we'll explore how reserve requirements help ensure stability and safety in the banking system, control the money supply, manage inflation and economic stability, and influence bank lending practices. Reserve requirements play a crucial role in maintaining the stability and safety of the banking system. They require commercial banks to hold a certain percentage of their deposits as reserves, providing a buffer of liquid assets to meet customer withdrawals and unexpected financial shocks. Additionally, reserve requirements are used to control the money supply. When central banks increase the reserve requirement, banks have to hold more funds in reserve, reducing the amount of money available for lending. Conversely, decreasing reserve requirements allows banks to lend more, increasing the money supply. Reserve requirements also serve as a tool to manage inflation and economic stability. By adjusting these requirements, central banks can influence the money supply, making borrowing more expensive to curb inflation or stimulating economic growth by making borrowing more accessible. Central banks use reserve requirements alongside other monetary policy tools, such as open market operations and interest rate adjustments, to implement their policies effectively. While reserve requirements are less frequently adjusted compared to interest rates, they still play a significant role in influencing the overall availability of credit in the economy. Furthermore, reserve requirements can impact the lending practices of banks. Higher requirements make banks more cautious about extending credit, while lower requirements can encourage more lending and borrowing, stimulating economic activity. It's important to note that reserve requirements vary between countries, and not all central banks use them extensively. Some central banks have shifted towards other tools to achieve their policy objectives. In conclusion, reserve requirements are a vital monetary policy tool that ensures stability and safety in the banking system, controls the money supply, manages inflation and economic stability, influences bank lending practices, and supports the implementation of effective monetary policies.